Hey everyone, welcome back to Corporate Decoder. Merck filed an 8K today, announcing they have received a notice from Nasdaq about not meeting the minimum bid price requirement. And this could be a serious warning sign. Quick note, this is not financial advice, just my take on public filings for educational purposes. Mercer International is on Nasdaq's radar for a potential delisting, and the company is already trading below $1. So what exactly is going on here? Mercer International Incorporated, which we follow as MERC, is a company that operates in the paper and paper products industry. They have a market cap of around $39 million, and their stock has been trading below $1, specifically at 58 cents recently. This is actually quite a significant drop from their 52-week high of over $4. The main news today is that MERC got a written notice from Nasdaq. The reason for this notice is that for the last 30 consecutive business days, the closing price of their common stock has been below $1 per S-share. This is a problem because Nasdaq has a rule called the minimum bid price rule, which requires stocks to maintain a bid price of at least $1. Now, it is important to understand that this is a notice of non-compliance, not an immediate delisting. The company is not getting kicked off Nasdaq today. They have been given an initial period of 180 calendar days, that is about 6 months, to get their stock price back above $1. To get back into compliance, MERC needs its stock price to close at $1 or higher for at least 10 consecutive business days within this 6-month window. If they can do that, Nasdaq will confirm they are back in compliance. The company says it is actively working to regain compliance. However, they also shared a very cautious outlook, stating, "There is no guarantee they will be able to meet the deadline." This lack of certainty is something we need to pay close attention to. Historically, companies that fall below the $1 mark and have to address a minimum bid price issue often face significant challenges. Think about companies that have gone through reverse stock splits to artificially boost their share price. About half of microcap companies that do reverse splits end up delisting eventually. For Merck, trading at 58 cents, it is a tough climb back up. If this were a hypothetical $1,000 investment at 58 cents a share, it would represent about 1724 shares. Regaining a $1 share price would mean more than doubling the current stock value. The company also included a standard forward-looking statement section. This is basically a legal disclaimer. They're saying that things they say about the future, like their plans to regain compliance, involve risks and uncertainties. They are warning investors that actual results could be very different from what they are predicting. They emphasize that there is no guarantee they will meet Nasdaq's listing standards. This is a pretty strong signal that the management itself isn't overly confident about a quick fix. The exhibits. This section of the filing mainly lists exhibits which are supporting documents. The most relevant one here is the cover page interactive data file, which is essentially digital metadata that helps with organizing and searching. There are no new financial statements or other substantive operational exhibits filed with this particular report. Looking at the broader context for Mercer International, they are in the paper and paper products business, which can be cyclical. Recent news from May showed their stock losing over 22% in 4 weeks, and they rescheduled their first quarter financial results release. This suggests there might have been some underlying issues or perhaps a delay in understanding their financial performance. Looking at the top institutional holders, Iowa T Reinsurance Co. Ltd. has a significant stake at over 25%, and Redwood Capital Management is also a notable holder. These large holders might have their own strategies for dealing with such a situation, but for individual investors, this Nasdaq notice is a serious concern. The core story here is that Merck is in danger of being delisted from Nasdaq. They have a grace period to fix their stock price, but the company itself admits there is no guarantee they will succeed. This situation often precedes difficult decisions like a reverse stock split, which can further dilute shareholder value if the underlying business performance doesn't improve. The risk I am watching is whether Merck can actually execute a plan to increase its share price, or if this is just the beginning of a longer downward trend that could lead to delisting. What I'm actually looking for is a clear path to sustainable profitability, not just a temporary fix for the stock price. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video, subscribe for more, and join our Discord community linked below.